This is Chapter 6 about inventories. First, we're going to talk about why we record and control inventory. First, we record inventory to keep track of anything that may be lost or stolen. Second, we keep track of inventory so that we can properly report it on our financial statements. Remember, GAAP has a lot of rules about reporting your financial situation, and part of that is recording our inventory. Purchase orders authorize individuals, employees, to purchase inventory from a vendor. So if an employee decides they want to purchase items, they fill out a purchase order, it's signed by their supervisor, and then they can use that purchase order to send it to the company they're buying from to purchase the item. For example, if I want to buy some school supplies, I get a purchase order, I fill it out, Mr. Worley would sign it, then I can send it to, let's say, Quill or Office Max, and they have the purchase order knowing that they're going to get paid for it because it's authorized, and now I can get my supplies. A receiving report establishes an initial record of the receipt of the inventory. Basically, it might be something like a packing slip that comes with the inventory and that shows that you received the correct items and that the bill, the invoice, can now be paid. The amount of the inventory is always available in the subsidiary inventory ledger. In the previous chapter on your review guide, it mentioned subsidiary ledgers. We will discuss those later, but the inventory is recorded always so that we know when we received it. We need to have controls to safeguard our inventory. Security measures such as tags that may be on there that sound alarms. Some places they check people's purses and bags, employees' purses and bags when they leave. Some other examples are having inventory stored in locked places where only certain people have access. Also, you could lock up the high price inventory in cabinets. You see this, my example would be if you've ever been to a place like Sam's Club. If they have expensive items, they're locked up in cases. Or if you go to Walmart, they lock up their video games in cases. They're not super high priced items, but they are things that are commonly stolen. You could also use things like two-way mirrors, so that this might be more of an office building. The manager boss can see what's going on in the other room. Security cameras, tags like I mentioned earlier, so if it passes the beeper system, it will make a sound, and security guards. Physical inventory is the count of the inventory we take at the end of the year or close to the end of the year to make sure our actual physical inventory that we have in the store matches our merchandise inventory ledger. Most times, your physical inventory count is going to be lower than what you have recorded in the ledger. Previously, we've discussed inventory shrinkage, where things might get stolen, which makes your ledger and the physical inventory count not match. Our second topic is to describe the inventory cost flow assumptions and how they affect the income statement and balance sheet. There's three costing methods that we will explore. First, it's the FIFO method, which means first in, first out. Then there is the LIFO method, last in, first out. And finally, average cost. Average cost method is rarely used. It requires extra work and really isn't conducive to any specific type of company. FIFO and LIFO are more commonly used. FIFO, first in, first out, might be an example like your fridge at home. You put the newer items in the back because the older items are going to expire more sooner. So the first ones in are going to be the first ones you take out because they're the oldest items. This is good for businesses who have perishable items, bakeries and food items. Last in, first out would work the other way. For last in, first out, items that are put in most recently are taken out. These are items where expiration dates and perishable items aren't a consideration, like clothing. If you buy more plain white t-shirts, the older ones aren't going to expire or go bad, so you just take the most previously or the most recently purchased items. Average cost, you actually calculate an average cost. You look at everything you've purchased and add it all together, divide it by the number of items, calculate an average cost, and that is used. We'll look at examples of each of these methods. So here is some basic data. We have 3 purchases. May 10th, we make a purchase of 1 item for $9. On the 18th, we purchase 1 item for $13. And on the 24th, we purchase 1 item for $14. So in total, we have 3 items, and we've spent $36. These are the first in at $9. These are the last in at $14. Our average cost per unit we can calculate at $12. You'll see you take $36 divided by 3 units. On average, it costs us $12 per unit. So we're going to assume that on May 30th, we sell 1 item for $20. Depending on which unit was sold, the gross profit is going to vary. If we take a look at sales, it's always $20 because we sold it for $20. Cost of merchandise sold is going to be what changes. If we look back at the previous slide, our May 10th purchase was $9, the 18th was $13, and the 24th was $14. So here, $9, $13, $14. May 10th was the $9 unit, so this would be first in, first out, because it was the first thing we purchased, so that's what we're selling. If we're using first in, first out, our gross profit is $11. On May 18th, the purchase cost us $13. So if we don't have a method, first in, first out, last in, first out, none of those matches this, but that item is going to give us a different gross profit. Demonstrating price changes are going to give us different gross profits. The May 24th unit, this would be our last in, first out, that was the last item we purchased, would give us a gross profit of $6. Then our ending inventory is what's left. We sold the one for $9, so we have the one for $13 and the one for $14 left. Sold the one for $9. We have the one for $13 and one for $14 left. For the May 18th, if we sell the unit that was for $13, we have the $9 and $14 one left. And finally, if we sold the $14, we have the $9 and $13 one left. So our ending inventory would be valued at $27 using this method. Our inventory would be valued at $23 using this method, and at $22 using this method. That is going to show up as an asset in our balance sheet. So that's going to come into play. Our gross profit is going to show up on our income statement. So depending on what method we use, our income statement and our balance sheet are going to look different. Under the specific identification inventory cost flow method, each item is sold is identified by the specific item. So every item is unique and different from every other item. So the order is irrelevant. It's a specific custom-made item for each order. We will not calculate any of these. It's a simple calculation. I sold this item, which was this cost, and that's that specific item. So it's not practical unless each unit is specific and different. If I have those white t-shirts I used as an example earlier, one white t-shirt is no different from another white t-shirt. It doesn't make any sense, and it's not practical to identify each specific white t-shirt by its own item number. Under the first in, first out, or FIFO method, the first units purchased are assumed to be sold, and the ending inventory is made up of the most recent purchases. So first in is first to be sold. The more recent purchases are what is left for our inventory valuation. So first units purchased are assumed to be sold first. First in, first out. Last in, first out. The last units purchased are assumed to be sold first, and the ending inventory is made up of the first units purchased. So our last units are sold. And the average the average inventory cost flow method, we figure out an average inventory each time that we make a purchase or sale. So the effect of this on the financial statements, here's a good visual example of that. FIFO method, we sold an item for $20. The cost of merchandise sold is $9. FIFO, first in, first out. Here's May 10th, the first item. That's sold. The gross profit is $11. So our balance sheet is going to show assets of $27. We sold the first one, the other two are left. The LIFO method, last in, first out. So here's our last item. That's what gets sold. There's our gross profit. And then our balance sheet is going to show the $22, the first ones that are not yet sold. Finally, the average cost method, you'll see down here at the bottom, on average they cost $12. That's our cost of merchandise sold, our gross profit. We had 3 items. We sold 1 for $12. The 2 left are $24. So it's going to make a difference on what shows up on the balance sheet because it's an asset. For the inventory costing methods, the most popular one is FIFO. Most people choose first in, first out due to perishability, expirations, technology becoming more obsolete. Average cost, again, least often used. So here's our first example. We've got 3 identical units of item QBM. They're purchased in February as shown. The first purchase is 1 unit for $45. Then we purchase 1 unit for $48 and purchase 1 for $51. So in total, that's 3 units at $144. They've done the calculations for average cost for you, $144 by 3 units. On average, it's $48 per unit. We're going to assume that 1 unit is sold on February 27th and we sell it for $70. Our problem asks us to determine the gross profit for February and ending inventory on February 28th using each of the methods. Take a moment to calculate. Remember, first in, first out, we're selling 1 unit from the first one we purchased. Last in, first out, we're selling 1 unit from our last purchase. Average cost, we're going to use the average cost that has been calculated for us. Have you calculated your answer? Let's take a look. Our first one, first in, first out, we're going to have $25 gross profit. Our first item was $45. So we take our $70 that we sold it for minus the $45 cost of merchandise sold, it's $25. We take the amount of our other 2 purchases, our second purchase of $48 and the third of $51. Our ending inventory is worth $99. Take a second if you need to correct B and C. Let's take a look at B. For letter B, last in, first out, the last item we purchased was $51. So our gross profit is $19. The $70 that we sold it for and the $51 cost of merchandise sold. Our ending inventory is the 2 items that we did not use, the first and second item, and ending inventory is valued at $93. Letter C, our average cost was $48 calculated for us on our previous slide. $70 is what we sold it for, minus the $48 average cost equals $22. Our last 2 items are both valued at the average cost of $48, so our ending inventory is $96. Take a moment, take a break, continue with the next set of notes.